Right now, gold is doing something that shouldn't be possible. Gold is near all-time highs. Real interest rates are positive. The US dollar is strong, and there is no panic in the headlines. That combination should not exist. In 40 years of watching markets, I have learned that when the obvious models stop working, it means the underlying system has changed. Here is what most media outlets are missing. Retirees are not moving to gold because they are afraid of inflation. They are not reacting to a CNBC segment or a gold coin commercial. They are moving because the US dollar is slowly, quietly, and structurally losing the one thing that made it the world's reserve currency: trust in its store of value. And the people who have spent 40 years building wealth for retirement can feel that shift before the economists are willing to name it. By the end of this breakdown, you will understand 3 things that will change how you see every headline about gold, the dollar, and retirement portfolios. First, you will see what central banks are doing right now that retirees are quietly copying. Second, you will learn the exact 4-step mechanism that breaks the old argument that gold is useless. Third, you will walk away with 3 specific indicators to watch if you want to stay ahead of the next currency shift before it shows up in the news. This is not a prediction. This is pattern recognition. And if you value this kind of system-level analysis that cuts through the noise, subscribe now. Let me show you what is really happening. Let me start with a number that should bother you. In 2023, global central banks bought over 1,000 tons of gold. That is the second largest annual purchase in history. The largest was 2022. Before that, you have to go back to 1967 to find a 2-year stretch like this. Now here is where this gets important. The mainstream narrative says retirees buy gold because they watch too much cable news and get scared by inflation headlines. That story is comforting, but it is wrong. Here is what the data actually shows. According to the World Gold Council, the single fastest growing demographic for physical gold allocation since 2021 is not doomsday preppers. It is Americans aged 60 to 75 with investable assets over $500,000. These are not panicked people. These are retired engineers, doctors, small business owners, and institutional investors managing their own IRAs. They are not buying gold ETFs for a short-term trade. They are taking delivery of physical gold into allocated accounts or home storage. That is a very specific behavior. It says, I do not trust the counterparty. Now zoom out. The puzzle becomes even stranger. Normally, gold falls when real interest rates rise. That is basic finance. Gold pays no yield. So if you can get a safe 4% from treasuries, gold becomes less attractive. But real rates went from -2% in 2021 to +2% today, and gold went up. Normally, gold falls when the dollar strengthens. Gold is priced in dollars, so a stronger dollar usually means a lower gold price. The dollar index has stayed elevated for 3 years, and gold went up. Normally, gold falls when there is no obvious crisis, no banking collapse in progress, no hyperinflation, no war directly threatening the US mainland, and gold went up. So here is the question the media refuses to ask directly. If the old models are broken, what new mechanism is driving the price? That is what we cover next. Stay with me. Let me be precise. The mechanism driving retirees into gold has nothing to do with inflation expectations for next year. It has everything to do with a 4-step breakdown in the dollar's structural credibility. Write this down. Step 1. Debt service costs force fiscal dominance. Here is what that means. The U.S. government currently spends over $800 billion per year just to pay interest on the national debt. That is more than the entire defense budget. When interest costs consume that much of federal revenue, the Treasury loses the ability to be a responsible fiscal actor. It cannot cut spending enough. It cannot raise taxes enough. The only politically possible path is to keep issuing debt and pressure the Federal Reserve to keep rates from spiking too high. That is fiscal dominance. The central bank becomes a servant of the Treasury, not an independent inflation fighter. We have not seen this clearly since World War II. Now, here is where this gets important. Foreign holders of U.S. debt see this happening in real time. Japan, China, Saudi Arabia, and even European allies have quietly reduced their treasury holdings for 8 consecutive quarters. They're not announcing it. They are not tweeting about it. They are just not rolling over maturing bonds. Step 2. The diversification accelerates. When a foreign central bank sells treasuries, it has to put the proceeds somewhere. Where do they go? Not into euros. The European fiscal situation is worse than the US in some ways. Not into yen. Japan is even more indebted. They are buying gold. In 2022, central bank gold buying jumped 500% above the 10-year average. In 2023, it stayed near those levels. The People's Bank of China added gold for 16 consecutive months. Poland added over 100 tons in a single year. Turkey, India, Singapore, all buying. These are not speculative traders. These are the institutions that manage the world's reserve assets. And they are signaling something very clear. We no longer want to hold only dollars. Step 3. The signal reaches sophisticated private capital. Family offices, endowments, and high-net-worth retirees watch what central banks do, not what they say. By early 2023, large private investors noticed that the official sector was buying gold at a rate not seen since the collapse of Bretton Woods in 1971. That is not a coincidence. The last time central banks bought gold this aggressively, the dollar was about to be decoupled from gold entirely, and the next decade saw inflation average 7%. Those private investors began allocating, not 5%, 10 to 15% in some cases. Step 4. Retirees follow the smart money. Now here is where the story changes from institutional to personal. The average retiree does not read central bank balance sheets, but they do talk to their wealth advisors. They do notice that their bond funds lost value in 2022 for the first time in 40 years. They do see that cash in the bank earns less than true inflation. And they hear from their peers that gold is not a relic. It is a hedge against a system where every major currency is debasing simultaneously. So they start with 1 to 2% of their portfolio. Then they see the price hold, then they add. By late 2024, physical gold dealers reported that the average retail purchase size had doubled from 2020 levels. Not because of fear, because of a slow, rational, structural realization. Let me show you why that matters. The headlines are wrong. Let me debunk 3 myths directly. Myth 1. Gold is a fear trade driven by inflation panic. That is true on the surface, but incomplete. Inflation panic produces spikes that reverse quickly. Think 1979. Think 2011. Gold shoots up, then crashes when the fear passes. What we have now is different. Gold has been grinding higher for 5 years, with lower volatility than the S&P 500 over the same period. That is not panic. That is structural allocation. Institutions do not panic buy physical gold. They reallocate over quarters and years. The price is moving for one reason. The dollar's value is changing for another. Myth 2. Retirees are being scammed by gold dealer ads. Let me be blunt. Yes, there are bad actors in the gold space. High markups, pushy salesmen, overpriced coins. But that is not the signal. That is the noise. The signal is that Vanguard, Fidelity, and BlackRock all launched or expanded physically backed gold products for retirement accounts between 2021 and 2024. The largest custodians on earth do not launch products based on TV commercials. They launch them based on multi-year demand from their own clients. And those clients are not idiots. They are retirees who watched the 2022 bond crash, wipe out their safe money, and decided never again. Myth 3. Gold has no yield. so it is bad for income. This is the most dangerous myth because it is mathematically true but strategically false. Let me explain. Gold has no yield. Correct. But bonds lost principal value in 2022 while inflation was running 8%. A bond that yields 4% but drops 10% in price is not a good income asset. A retiree needs stability of purchasing power, not just a coupon payment. Gold provides zero yield, but also zero default risk, zero counterparty risk, and zero duration risk. In a world where real yields are manipulated by fiscal dominance, that zero becomes more valuable than a positive number that comes with hidden risks. The mainstream narrative is asking the wrong question. They ask, why would anyone buy something that pays nothing? The right question is, why would anyone trust a yield that is engineered by a government that cannot balance its budget? That is the shift retirees have already made. Now zoom out. Because this has happened before. And the last time it happened, most investors realized the truth 5 years too late. Now let me take you back. Because if you do not understand 1971, you will not understand 2025. Here is what happened. From 1944 to 1971, the world operated under the Bretton Woods system. The dollar was backed by gold at $35 per ounce. Every other currency was backed by the dollar. It worked until it did not. By the late 1960s, the US was printing more dollars than it had gold to back them. France and Germany noticed. They started redeeming their dollars for physical gold. On August 15, 1971, President Nixon closed the gold window. The dollar was no longer convertible. That was not a collapse in a single day. It was the end of a 40-year regime. Now here is where this gets important. Between 1971 and 1980, gold went from $35 per ounce to $850 per ounce. That is a 2,400% increase. Inflation averaged 7%. The stock market went nowhere for a decade. And here is what most people forget. For the first 2 years after 1971, almost nobody understood what was happening. Mainstream economists said gold was a barbarous relic. They said the dollar would remain strong because there was no alternative. They were wrong, not because they were stupid, because they were using an old model for a new regime. Now compare that to today. We are not in 1971. We are in 1968. Let me explain. The current regime, fiat dollars, globalized trade, independent central banks, has been in place since early 1990. Regime ends when the debt burden becomes unsustainable and the reserve currency issuer loses credibility. Watch the numbers. In 1998, it was 35%. In 2000, it was 55%. In 2008, it was 70%. Today, it is over 120%. No country in modern history has sustained debt to GDP above 130% without either default, financial repression, or a currency crisis. The US will not default. It will print. That is financial repression. And retirees know what that means. It means the dollars they saved over 40 years will be worth less with each passing year. Not because of a sudden crash, but because of slow, engineered erosion. That is why they are moving to gold. Not because they expect a 1970s-style spike overnight. Because they expect a 1970s-style erosion of purchasing power over a full decade. And gold is the only asset that has survived every single currency regime in recorded history. The Roman denarius, the Spanish real, the French livre, the British pound sterling, all of them devalued. All of them collapsed relative to gold over the long arc. The dollar will be no different. The only question is timing. And retirees are not trying to time it. They are trying to survive it. Let me show you exactly what to watch. If you take nothing else from this breakdown, Watch these 4 indicators. They will tell you everything the headlines will miss. First, watch the U.S. Treasury auction cover ratio. Every month, the Treasury sells bonds. The cover ratio is how many dollars bid for every dollar sold. For decades, the cover ratio averaged 2.5 to 3.0. In 2024, it dropped below 2.0 for several auctions. That means demand for U.S. debt is weakening. When the cover ratio stays below 2.0 for 4 consecutive auctions, the Treasury has to raise yields to attract buyers. Higher yields slow the economy, but the government cannot afford lower tax revenue. That is the trap. Watch for cover ratio below 1.8. That is the danger zone. Second, watch the LBMA gold inventory withdrawal rate. The London Bullion Market Association publishes weekly gold inventory data. In normal times, inventory fluctuates slowly. Since 2022, physical gold has been leaving London vaults at the fastest rate since records began in 2011. That gold is going to Switzerland for refining, then to Asia and the Middle East. It is not coming back. When physical inventory drains while paper prices stay stable, the paper market is decoupling from the physical market. That cannot last. Watch for a week where LBMA inventory drops by more than 1%. That will be the signal that physical demand is overwhelming the paper market. Third, watch the dollar's trade-weighted index breaking 90. The U.S. dollar index has traded between 90 and 110 for 15 years. If it breaks below 90 and stays there for 3 months, foreign central banks will accelerate their diversification. That will trigger another wave of gold buying from sovereign wealth funds. They do not wait for confirmation. They front-run the move. Fourth, watch the yield curve steepening past 150 basis points. The curve is inverted now. Short-term yields are higher than long-term yields. When it uninverts and steepens past 150 basis points, that is the historical signal that a recession is coming. But more importantly for gold, a steepening curve means the market is pricing in persistent inflation and higher term premiums. That is the exact environment where gold outperforms both bonds and stocks. Write those 4 down. Cover ratio below 1.8. LBMA inventory drop above 1% in a week. Dollar index below 90. Yield curve above 150 basis points. When you see 2 of those 4, the regime shift is no longer coming. It has arrived. Let me close with something uncomfortable. This is not a prediction of collapse. I have seen too many analysts cry wolf to do that. But it is a description of a quiet transition that is already underway. Retirees are not moving to gold because they are afraid of tomorrow. They are moving because they have lived through enough cycles to recognize when the rules have changed. The dollar will not fail overnight. It will fail slowly, then suddenly. First, the debt auctions get harder. Then the foreign buyers step back. Then the Fed is forced to choose between inflation and default. Then the currency adjusts. And by the time the headlines announce the crisis, the retirees who move to gold will already be protected. The rest will ask, why did nobody tell us? Someone is telling you now. The question is not whether gold will go up. The question is, what are you holding when the store of value changes? Because every reserve currency in history has lost that status. Every single one. The dollar will not be the exception. The only choice is whether you prepare before the crowd or after. That is the real reason retirees are moving to gold. Not fear, not hype, not a commercial. And if you have made it this far, you now see it too.